Hello to all of our EarningsBeats members. For those of you who don't know me, I think everyone knows me, but if not, I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. I know plenty of you have sent many questions in over the last several weeks, months, years. We do try to get back to those as quickly as possible. I think the initial response is very quick. Sometimes if you're waiting on me, it can take a while because I do have a lot of other things going on, but I really do feel like your questions are important, and we do want to try to get to those questions as quickly as we can. So one thing we're going to start with this week is we're going to start doing recordings of any questions that you have that really are more questions that could appeal to a lot of members. We really don't, it's really hard for me to do individual stock questions. We have a lot of members, and I'd be spending most of my days just answering questions on stocks. But when you do have an issue following one of the concepts, one of our products, something that I think could relate to a lot of folks at EarningsBeats, I want to try to get an answer to those questions and get it out, to everyone. So I think using these videos, will help me get to more questions and try to get those back to you as quickly as possible. And again, if it's a question that many of you might have, it eliminates all the questions coming in individually, which I think will save us all a lot of time. So anyway, I had three questions that I wanted to address today in this video. And the first one is dealing with the equity-only put-call ratio. So the question that came in was, could I show how I set up my chart for the 253-day equity-only put-call ratio? So that's just following the moving average for 1 year. 253 days, trading days is essentially 365 days. So that's where that 253-day moving average comes from. But let me go ahead and show you on this chart. I just pulled up the $ CPCE, and this is the chart that I normally would get. This is my default chart on a daily chart. So if you want to set it up the way I do from a sentiment perspective, long-term sentiment, if you scroll down, first thing I would do is change. I mean, we want to look more than just a year. So I'm going to go back and pull it up for the last 20 years. I'm also going to change this, the chart, one of the chart attributes. Normally I show this in candlestick form. But I want to show you what happens when I switch this to invisible. So you just hit that drop down menu, scroll down toward the bottom, and you'll see invisible, another kind of a chart. And when I click on invisible, what's going to happen is all the day-to-day activity is going to go away, and all you're going to see is the moving average. Okay. So here, if I do that and I click up, well, I'll get rid of the volume. Volume isn't important. We don't need RSI. Get rid of that. For now, get rid of the PPO. All we want to do is just see that price action, but we want to hide the day-to-day and just show moving averages. So the key there is under chart attributes, go down to type, hit that menu, go down to invisible, make sure you set it to invisible and hit update. And so now what you will see is just the blue and the green lines. These are the moving averages. You can see right up here in the upper left-hand corner, it'll show you the green is the 20-day EMA and the blue line is the 50-day SMA. Well, the only thing I'm interested in is the SMA, the 253-day SMA. So now I can go down to overlays because that's the only thing printing on the chart. Because remember, I've got it on invisible. So I've gotten rid of all of the data, the individual daily data. So don't need an exponential moving average, but what I do need is that 253-day simple moving average. So there you have it. I hit the update, and now this is what you're used to seeing on that 253-day moving average. Now, what I like to do is I like to add the S&P 500 below. And so when I do that, I go under indicators. I've got to go down to price. And then S&P 500 is the default. I'll go under style. I like just to use a solid thick line. And then I use a 1.0 height, meaning that the panel beneath is going to be as tall as the actual chart itself. So if you wanted it half the size, you'd click height half. Down here, go down to 0.5. But I want it full size. So now I hit update, and now I've got my chart. This side, or this top panel, which shows the 253-day moving average, simple moving average of the CPCE, is in the top panel, and here's the S&P 500 in the bottom panel. Now, the only really bad thing about this is that down below, this is an arithmetic scale, not a log scale. So you can see every 500 points is the same distance from one another. So it almost looks like we're going parabolic, which we really aren't. We're just kind of going along in a channel. On a weekly chart, if you pull up the S&P 500, you can connect the channel. So we're not really seeing, it looks like we're making this huge run, pullback, and then this parabolic move to the upside. But it's not showing it on a log scale, which shows percentages. It's actually showing it on an arithmetic scale, which is showing actual points. Well, 500 points from 5,500 to 6,000 looks like the same as going from 1,000 to 1,500. That's not true. I mean, 1,000 to 1,500, you're gaining 50%. From 5,500 to 6,000, you're gaining less than 10%, like 9%. So you can't really compare, and that's what makes it start to look like a parabolic move, and it also makes it hard to read changes from years ago. So that's the only downside to this. But usually when I'm doing this, what I really want to point out is just simply that when we peak in terms of fear and we start to roll over, this is the 253-day moving average. I've shown this many times before. But as you look at this and see the tops form and start to roll over, you can take a look at what happens to the S&P 500. So the S&P 500 from here to here goes up. And when the fear is coming down, we go up. Fear is coming down, we go up. Fear is coming down, we go up. And fear, this is where we are right now. Fear is coming down. A lot of people want to shoot down this bear market, think it's gone too much. That fear is still coming down, and I don't think it's going to stop until we at least get down below 0.60 and maybe down to 0.575. And it could keep going. I mean, the lowest we've ever gotten was back at the end of 2021 in the 0.45 area. And then to the upside, the worst fear came in 2009 when we had the financial crisis and we got up to a 253-day SMA reading of 0.775. So I don't know exactly where it's going to go, but I do know that the fear is coming out of the market. And when that happens, folks are starting, there's still some people clinging and saying, oh, the market can't go up, can't go up. Eventually, we'll get to the point where everybody thinks the market's going to go up. And that is when we want to be careful. So anyway, I hope this demonstration helps you understand that 253-day moving average of the CPC a little bit better and how we use it at EarningsBeats. All right, question number 2. So question number 2 deals with our portfolios and when to get in. A lot of our portfolio, these are momentum portfolios. So we're not generally going to get stocks that are testing 52-week lows. These are going to be stocks that are in clear uptrends. Sometimes they look like they're in stealth uptrends. What we do at EarningsBeats is we find what we believe are the 10 best stocks to put in each of the portfolios. Generally, they're equal weighted. We do have an exception with 2 smaller software stocks in our aggressive portfolio where we have 5% in each one, just so we didn't have a full 10% in a couple of smaller software stocks that could really have big or bad quarters. And so we wanted to just kind of spread the risk around a little bit. So that's why we had 2 of those. But generally, it's 10% in each stock, 10 stocks in each portfolio. What we always talk about when we do the draft and we put these stocks into our portfolios is that it's really up to each and every member to decide I can't make the decision on what risk what risk members are willing to take. I don't know individual, financial goals. I don't know where you're currently sitting financially. I don't know ages. I don't know anything. So it's not a one size fits all. Like everyone just go in and buy. Um, I think that would be a big mistake. But what we do at EarningsBeats is say, okay, as of this date, we're buying our stocks. And when we get to the 19th of February, we're going to be unloading our stocks. Now, as we get closer to that date, we might say, hey, we're going to get out on the 17th, or hey, we're going to wait and give it a couple more days, or something like that. But generally, we're going to hold 90 days and we're going to get in. Sometimes when these stocks are very overbought, they may pull back, they may not. Whether or not you decide to get in to these portfolios or not, it's completely your decision. I am not a registered investment advisor. Um, I don't claim to be one. I usually will throw that out there that I'm not a registered investment advisor. No one at EarningsBeats is a registered investment advisor, and EarningsBeats itself is not a registered investment advisor. So we're not licensed to tell anyone when to buy or when to sell. What we do for these portfolios and the way this all started was members asked back in 2018 when we were using the strong earnings chart list. We didn't have all these chart lists. We had much fewer. And their key one, the flagship, was the strong earnings chart list. And I kept saying, this is the chart list that I like to trade off of. Well, members would look at it and say, well, there's 3 or 4 or 500 stocks on it. Can you narrow it down to some of your favorites? And that's when the model portfolio was born. I went through the portfolio, or I went through the chart list, and I basically just handpicked. And we call it the portfolio draft because I'm free to pick whatever 10 stocks I want. If I pick Apple, it's not like somebody else picks Microsoft and I can't pick Microsoft. I can pick Apple, I can pick Microsoft, I can pick whatever 10 stocks I want and put them into the portfolio. And we do this every quarter, but it's really a combination. It's got some trading strategies involved. It's also got buy and hold strategies. So it's kind of a mix of both. And it was really set up to appeal to members who are not day traders, are not actively watching the market every single day. These are folks that want to benefit from relative strength and a lot of things that we talk about and that we teach, but they don't want to have to go in and look and make trades every single day. They might be at work. They may be retired. Maybe they're out doing charitable stuff. They're not sitting in front of their computer all day. And so that's how this was born. And so unfortunately, I don't have an answer because to me, it's a question for each individual. Like I said, we try to be very, very transparent. We try to be very simple in how we set up these portfolios, how we enter, how we exit. It used to be that we'd enter at the close on the 19th, and we actually had our event after that close. So we were talking about stocks and saying we just entered as of today's close, but members couldn't enter until the next morning. And so now what we're doing is we're doing the event before the actual portfolio will go into effect. And so we might do it on the 18th or the 17th and say, as of the 19th, we're getting in as of the closing price. And members will say, well, does that mean we get in at the next open? No, we're getting in as of the close. So technically, you would be going in at 3:59 p.m. Eastern time, right before the close. And whatever the closing price is our buy price. Again, just trying to be simplistic, on the up and up, easy to track. The problem is if we throw 10 stocks in there and we decide, well, we're going to wait. Okay, we're going to buy this one today. And then 3 days later, we're going to buy this one. And then anybody who's following this isn't what this was designed for. It wasn't designed for folks to be getting multiple times. And you almost have to be at your computer and trading to get that and act on it. So what would happen and what has happened in the past is if we gave out stocks with different timing, inevitably somebody would write in and say, oh, I missed it. I didn't get that email. Should I get in now? And at that point, maybe it's gone up 10%. So it's always some of those questions. So what we do is we try to make it as simple as possible. Say, look, as of November 19th close, this is what we're getting. Here are the stocks, and we're holding for 90 days. If you look at the charts and you decide, hey, this one's really overbought, I'm not comfortable buying it, I don't fault you. Um, some of them are very overbought. But as you've seen this quarter so far, some of these really overbought stocks haven't pulled back. They just keep going up. And unfortunately, a lot of times small caps, well, actually, fortunately, if you're in them, but small caps and mid caps, sometimes when they get going, they're like semiconductors. I mean, they just absolutely explode to the upside. Um, and many of these aggressive stocks, even the mid caps, or some of them, not all of the stocks in our portfolios are small and mid cap. We have some large cap as well. And you look at a stock like Palantir, which is just going off the charts, it just keeps going up almost every single day, not really giving us much of a chance to get in. And then the other thing is when a stock's going up and you finally do get that pullback, you're afraid to pull the trigger because you think it might go down a little bit more. And so we just try to stay clear of all of that and say, okay, this is where we're getting in. This is the date. Here are the prices, and we'll revisit 90 days. We have left open the possibility that maybe we'll reallocate and kind of redesign our portfolios in the middle, or excuse me, maybe in the early part of January. Still considering that, but I'm just going to see where we stand, and we'll keep you posted on that. But otherwise, we're just holding. We're buying and holding. If we get them and they're overbought and they pull back, we accept those short-term losses. If we get in and they're overbought and they just keep going up, we participate. Long answer to a short question, but hopefully that helps. But the key is, please remember, we are not registered investment advisors. I am not recommending or advising anyone to buy or sell, which leads me to our third question, which is question came in about the IWM and the TNA. And this question comes in all the time because I've talked about small caps and the fact that I really like the IWM in 2025. And I've also talked about trading from time to time the TNA, which is the 3 times leveraged ETF that tracks the IWM. So in theory, if the IWM goes up 1% one day, the TNA should go up 3%. And likewise, if the IWM goes down 1%, TNA would go down 3%. So it's just a way to leverage, put the same amount of money in, but now you're controlling 3 times the number of shares. That's great when it's going up. It is not great when it's going down, at least if you have a long leveraged ETF. But the question that came in is, my current position, what do I suggest? Or actually the wording was, what do I recommend in terms of establishing positions? I don't like the word recommend. I don't like the word advise or advice, because again, to me, that's kind of gray line there as to whether or not you're acting as a registered investment advisor. And again, we're not licensed as registered investment advisors. What we do, and the way I look at EarningsBeats, is we provide market guidance, we provide market education, and we provide market research. We don't provide day-to-day trades. Anytime I show a chart, I highlight key support levels and so forth. To me, it's just trying to teach the way I trade. How you do, you may trade completely different. I've had members say, well, I don't like pullbacks. I like to buy on strength. I like to buy when a stock's going up. I like to add when it's going up. That's fine. There's different strategies for everyone, right? There are a lot of different ways to make money. Whatever works for you. You might have a tight stop strategy. I might have a little bit, well, I try to keep mine fairly tight, but it's easier for me if I can get into a stock closer to a support level. So I like leaders that are trending up, but I would prefer to try to get stocks either on a pullback or just as they're making a big breakout above key resistance. So as far as the IWM goes right now, what I'm looking at is I see a move to the upside. I see a cup. I see a little bit of a handle coming back. As we hit resistance, at that point, we saw money rotate back over into the SPY, the Spider, the S&P 500, and also the NASDAQ. A number of the Mag 7 stocks just had a big week. And I fully expect that with the breakout, some of these are going to continue to do well. But we'll also see money rotate back. They'll get overbought, money will rotate back, and at that point, I think we'll see small caps go again. Over time, nothing has changed. I still believe IWM is going to be the best performer in 2025, better than the NASDAQ, better than the S&P 500, better than the Dow. But that remains to be seen. That may or may not be the case. We'll adjust as the year goes on. As I'm seeing it, I'm not going to be stubborn. And 4 months from now, if the IWM has been lagging all year, I'm not going to say, well, I'm still certain it's, I'll be looking at it and I'll be saying, hey, it's not working. But right now, I like the IWM as, on this pullback as it moves into this handle. We do have short-term weakness historically coming up next week. So that would absolutely eliminate any thought for me of getting in the TNA, which is the 3 times leveraged long ETF. I just don't want to take on that additional risk in a week that I know historically hasn't been a great week. If it goes up, I got the IWM. That's great. If it goes down, that might work out well too, because I can go down with the IWM. And if I hit maybe the 20-day, or if I hit a key support level, or if I print a positive divergence on a 60-minute chart, something like that, I could flip and head back into the TNA at that point. But I don't have set levels necessarily where I would move from IWM to TNA. If there was one level, it would be the 20-day EMA. That would be one level. If I really am expecting, the small caps to take off and to start leading again, maybe we get past the 15th of the month and we start turning, moving into a more bullish period, and we're hitting the 20-day moving average and we print a hammer. Those are types of things that would get me more bullish and more confident of an uptrend. And at that point, I might switch over to the TNA. But anyhow, those are answers to those 3 questions. We certainly do appreciate your support and following us. Many of you have followed us for so many years. We really appreciate all of our members, but especially those of you that have been with us since the start of all this. And we do still have a number of you. But all members that are supporting us really help us to do what we do, and help us to, to bring in, folks like Aaron and Matt and Tyler and Chris, and of course, John and I. And so we couldn't do it without all of y'all. So thank you so much for your support. Send in the questions. I will try my best to get to them as quickly as I can. Keep in mind that I do address a lot of individual stock questions on Wednesdays when we have our live trading rooms, live trading room sessions. So, if you're looking for individual stocks, that's by far the best opportunity to get those questions answered. Otherwise, I will try to do this video maybe once a week to try to go through some more standard or more routine types of questions that are not relating to individual stocks. So thanks so much for the questions. Hopefully my answers were helpful. If you like this, write into us at support@earningsbeats.com. We'd love to hear, if this is a value-added service going forward, if this is something that you would like to have. So with that, we'll end our first Q&A session. Have a great weekend, everybody. Happy trading.